3 years ago, I was staring at my computer screen at 2 a.m., completely overwhelmed by the 847 different ETFs available on my brokerage platform. I had analysis paralysis. Sound familiar? I kept reading about these simple 3 ETF portfolios, but something felt missing. Then I discovered this one modification that transformed everything. This simple 4 ETF formula has generated over 15% annual returns in my portfolio, and by the end of this video, you'll have the exact blueprint I use to build my way toward a $500,000 portfolio. Let me tell you about Sarah, a 28-year-old elementary school teacher from Ohio. Like most of us, she started investing with good intentions but felt completely lost. She'd heard about the famous 3 ETF portfolio. You know, the one everyone talks about. Broad market, international, and bonds. Simple, effective, boring. For 2 years, Sarah religiously put money into this setup every month. Her returns were okay. Nothing spectacular, just matching the market. But Sarah had a problem that many of us face. She was young, had decades to invest, and felt like her portfolio was playing it too safe. She was missing out on potential growth, missing out on income, and missing out on the opportunities that could actually accelerate her wealth building. That's when Sarah discovered what I'm about to share with you, the missing piece that changed everything. Here's exactly what that 4th ETF was, and more importantly, how to choose the right one for your situation. Before we reveal that game-changing 4th ETF, let's build the foundation properly. Think of your portfolio like constructing a house. You need a solid foundation before you can add the exciting features. Your first ETF is your portfolio's backbone, and this is where broad market ETFs come in. These funds are like owning a slice of America's biggest and most successful companies all at once. When I tell people about ETFs like VOO, Vanguard's S&P 500 fund, I explain it this way. For just a 0.03% expense ratio, you become a part owner in Apple, Microsoft, Amazon, and 500 other companies. VTI takes it even further, giving you the entire U.S. stock market for that same tiny 0.03% fee. These aren't trying to beat the market. They are the market. Over decades, they've delivered consistent, reliable growth through recessions, panics, and booms alike. Your second building block is your income generator, and this is where dividend ETFs shine. Here's something most people don't realize. While others panic during market crashes, smart dividend investors actually smile. Why? Because companies like Coca-Cola, Johnson & Johnson, and Procter & Gamble keep paying you regardless of what the stock price does that day. Funds like VYM, with its 2.63% dividend yield and 0.06% expense ratio, turn your portfolio into an income-producing machine. Imagine waking up every quarter to payments hitting your account, money you earned while you were sleeping, working, or spending time with family. DGRO takes a different approach, focusing on companies that don't just pay dividends, but grow them year after year with a 2.19% yield and 0.08% expense ratio. Now for your growth engine, and this is where things get exciting. Growth ETFs are for investors who want to harness the power of innovation and expansion. These funds pack companies that are rapidly expanding revenues, capturing market share, and reshaping entire industries. We're talking about the Apples, Microsofts, and Amazons of the world, along with emerging companies that could be the next big thing. SCHG and QQQM represent this growth philosophy perfectly. Yes, they're more volatile. They'll take you on a roller coaster ride. But here's why that volatility is actually your friend. Over long periods, these growth-focused funds have historically outperformed the broader market. The key is having the stomach for the ride and the time horizon to let compound growth work its magic. Now comes the moment of truth, choosing your 4th ETF. This decision will define your portfolio's personality and determine whether you're playing it safe or swinging for the fences. I've identified 3 distinct paths, each suited for different types of investors. Let me introduce you to 3 people who represent these paths perfectly. First, meet James, the global explorer. James learned about diversification the hard way during the 2018 market correction, when his all-U.S. portfolio got hammered, while international markets held up better. James represents the investor who chooses international ETFs as their fourth holding. International funds like VXUS give you exposure to companies beyond U.S. borders, European giants, Japanese innovators, and emerging market disruptors. Here's the beautiful thing about international investing. These markets don't always move in sync with the U.S. When America struggles, sometimes Europe or Asia thrives. James now runs a portfolio that's 60% VOO for that broad market foundation, 20% SCHG for growth, 10% VYM for dividend income, and 10% VXUS for international exposure. Over the last 10 years, this combination delivered 13.5% annual returns. Now that's actually 0.1% lower than the pure S&P 500. And that's because international markets have struggled recently. But here's the kicker. In 2025, international has actually outperformed the S&P 500. James isn't trying to maximize returns. He's building a fortress that can weather any storm. Then there's Maria, the calculated risk taker. Maria understands that sometimes you have to think smaller to win bigger. She chose small cap ETFs as her fourth pillar. Small cap companies, those with market caps between $250 million and $2 billion, are like the scrappy underdogs of the investing world. They have room to grow that large companies simply don't. When a small company doubles in size, its stock can soar. When Apple doubles in size, well, that's adding another $3 trillion to an already massive company. Maria runs two variations of her 4 ETF strategy. Her aggressive version keeps the same 3 foundation ETFs, but adds AVUV, the Avanti Small Cap Value ETF, at 10%. Since September 2019, this portfolio has generated 16% annual returns, nearly 0.5% better than the market. Her conservative version swaps out the growth ETF for international exposure and bumps up her allocation slightly. This gives her exposure to the entire stock market spectrum from tiny companies to global giants. Since 2019, this setup has delivered 14% annually while being incredibly well diversified. Finally, there's David, the digital pioneer. David represents the new generation of investors who understand that the financial world is changing rapidly. With recent developments in crypto regulation and policies that are making Bitcoin more mainstream, David chose a Bitcoin ETF as his fourth pillar. Bitcoin ETFs like FBTC, Fidelity's Wise Origin Bitcoin Fund, offer a simple way to get crypto exposure without dealing with digital wallets or exchanges. David's portfolio combines his 3 core ETFs with 10% allocated to FBTC. Now, I have to be honest with you. This is the wildcard option. Since FBTC launched in January 2024, David's portfolio has seen nearly 50% total returns, with the Bitcoin ETF alone contributing over 160% gains. But remember, what goes up fast can come down fast too. So how do you choose your fourth ETF? Here's the framework I use when helping people make this decision. If you're in your 20s or 30s with decades to invest, you can afford more risk. Small cap or Bitcoin exposure might make sense. If you're in your 40s or 50s, international diversification often provides that sweet spot between growth potential and risk management. If you're approaching or in retirement, the income focus of dividend ETFs becomes more attractive, though you might already have that covered in your core 3. Think about your risk tolerance honestly. Can you sleep well knowing 10% of your portfolio might swing 20% in a single day? If yes, Bitcoin or small caps could work. Do you prefer steady, predictable growth even if it means potentially missing out on explosive gains? International diversification is your friend. Are you someone who gets excited about collecting dividend payments and watching your income grow over time? Maybe you double down on dividend strategies or add international dividend funds to the mix. Here's something crucial. These allocation percentages aren't set in stone. If 10% Bitcoin feels too aggressive, try 5%. If you love the international diversification story, maybe go 15% instead of 10%. The beauty of this 4 ETF approach is its flexibility. You can adjust based on your comfort level, life stage, and goals. But here's what nobody tells you about 4 ETF portfolios. And I'm going to be brutally honest because your financial future is too important for sugarcoating. First, More ETFs doesn't automatically mean better returns. Sometimes simple wins. The S&P 500 alone has beaten many complicated strategies over long periods. Second, the fourth ETF you choose today might not be the right choice 5 years from now. Your life changes, markets change, and your strategy should evolve too. Third, timing matters more than most people admit. Adding Bitcoin exposure in early 2024 was brilliant. Adding it at 2021 peaks? Not so much. International has underperformed for years, but might be poised for a comeback. Small caps can go years without outperforming before suddenly exploding higher. The biggest mistake I see people make is constantly switching their fourth ETF based on recent performance. They chase last year's winner and miss this year's opportunity. Pick your strategy based on long-term conviction, not short-term performance. And remember, even the best 4 ETF portfolio won't make you rich overnight. This is about building wealth steadily over decades, not getting rich-quick schemes. So here's my challenge for you. Which fourth ETF resonates with your story? Are you James, building a globally diversified fortress? Maria, betting on small company growth potential? Or David, embracing the digital financial revolution? Drop a comment below telling me which path you're choosing and why. I read every single comment and often respond with personalized advice. If this breakdown helped clarify your investment strategy, smash that like button. It really helps the algorithm share this with other investors who need to see it. Make sure you're subscribed with notifications on, because that video could change how you think about portfolio construction forever. Until then, keep building that wealth, and I'll see you in the next one. This video is for educational and informational purposes only. Investment performance shown is based on historical data and projections. Past performance doesn't guarantee future results. Always conduct your own research and consult with a qualified financial advisor before making any investment decisions. Thanks for watching.